Corporate Finance OneNote Practice Problem. In this presentation, we will work a practice problem in OneNote related to the calculation of the break-even point, and then we'll go into more detail about the fixed costs and variable costs, allocating costs between the categories of fixed costs and variable costs. Get ready, it's time to take your chance with Corporate Finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to, but if you have access to it and would like to, we are in the 512 break-even point and fixed and variable costs tab in the practice problems section. Closing this back out, we're going to have two problems that we will work through. We're going to go through the break-even analysis, a break-even point calculation again, similar to what we've seen in the past. Then we'll talk more about breaking out between variable costs and fixed costs, which is going to be a key component to doing break-even analysis. So we have the break-even point we'll take a look at. We have the sales price per unit, $30 this time. Variable cost per unit, $16. The fixed costs, $30,000. So once again, when we're projecting into the future, we want to think about our variable costs and fixed costs. In other words, we want to group our expenses, not by what they're used for so much as the relationship of how they will behave with relation to sales changes, so that we can then think about how many sales we need to have. That makes it a lot easier to make projections and different scenarios into the future. So we're saying the variable costs are going to be the ones that will change with relation to the sales volume, and therefore we have this nice relationship between the sales and the variable costs. Now again, it's not a perfect world to be breaking all costs out into the variable costs and the fixed costs. We're going to have to make assumptions in order to do that. And when we do make assumptions, there will be trade-offs with regards to complete accuracy and the ability to have a flexible kind of budget. So there's always trade-offs when we're thinking about the future and projecting into the future. But when we can do this kind of analysis, it really frees your mind up to start thinking about different types of scenarios and run, fast projections on them, so that you can do a lot easier and more effective brainstorming. So if we then take a look at our formula, with the formula for the break even in units, so how many units do we need to be able to sell in order to break even, is going to be our fixed costs. Things I would have the most common example, or the example that rings in my mind the best, the rent, right? The things, but anything that doesn't change is going to be a fixed cost. It doesn't change with relation to the increase and decrease in the sales volume, divided by what could be called the contribution margin per unit. Contribution margin per unit being calculated at the sales price per unit minus the variable cost per unit. So get used to that concept of the contribution margin per unit, and there's going to be a contribution margin and contribution margin per unit. So we're thinking contribution per unit here, the sales price per unit minus the variable cost per unit. So then I would start breaking some of these formulas down when we take a look at finance type of formulas into a more expansive kind of tax return type of format, a spreadsheet type of format. I think it's easier or useful for us to analyze each component in that way. Although, of course, you can plug this information directly into a calculation and work the algebra. But if you see it vertically in kind of a tax return type of format, I think it's easier for a lot of people to kind of visualize what is going on. So what we're going to do then is in the outer column for this formula and some formulas going into the future, we'll end up with our numerator and denominator that we will then divide out, and then we'll do the calculations of each of the numerator and denominator components in the intersection in kind of a tax return or worksheet type of format. So the fixed cost is going to be the numerator. Those are the things that don't change, things like the rent, things that are going to be stable or stay the same with increases and decreases in sales volume. Then we're going to calculate the contribution margin per unit. We're going to put a colon here because that's going to be representing the fact that we're going to have a subcategory calculation. That's going to be the denominator, sales price minus the variable cost, both per unit. So then we're going to take the sales price per unit, $30 in our example here, minus the variable cost per unit, the $16. That's going to give us our contribution margin, the $14. That's the denominator of our formula, the sales price per unit minus the variable cost, which is the contribution margin per unit. Now that we have the $30,000 fixed cost and the contribution margin per unit, we can do our division problem here. We're going to take the old 30,000 and divide it by the 14, and that'll give us the number of units we need to then make in order to break even, in order to cover the fixed cost, the 2,143. So you can see how that's a nice launching point, a nice easy, launching point to then think about, well, what do we need to do to make a profit then? Well, if we want to make a $10,000 profit above the 30,000, we can take the 30,000 that we need to break even, plus we want to make profit enough of the 10,000. That's where we would like to get to. So we have a 40,000 in kind of the fixed cost plus the profit divided by the contribution margin per unit, 14. That would mean we'd have to sell 2,857 in terms of units to get to our objective. So that's going to be a useful calculation. We're going to use these. We can actually make a whole income statement using a similar process with the variable costs and the fixed costs, which we'll do later. I would call it a contribution margin type of income statement. All of that could be categorized under the category of break-even analysis, even though break-even analysis, you would think about the major formula, which would be the break-even in units here. But you can also think about anything that is breaking the costs out by behavior might be grouped in the general term of break-even type of analysis, as opposed to normal financial statement analysis. When you're judging like the past history, you're breaking the costs out by what they are used for, such as cost of goods sold, selling expenses, admin expenses. And this variable cost here, for example, probably will include things that are going to be like direct material, direct labor, things that would change with relation to the sales volume, but could include things that are in selling and admin, such as commissions and whatnot, that might vary, of course, with the change in the sales volume as well. So now what we will do is we'll prove that this is a break-even point in units, that 2,143 about, by making an income statement, but we're basically going to make it a contribution. I would call it a contribution margin type of income statement. So in other words, instead of having an income statement, which will typically start off with sales minus cost of goods sold gives you gross profit, we're going to take the sales minus the variable costs gives you the contribution margin. So that means we're going to look at it in this format. Sales is going to be the top line number, as is the normal income statement. We're going to break it out and calculate the units, the sales price per unit, which we said was $30, times the number of units that we're going to sell. And now we're going to plug in our break-even point, that 2,143. And that then, the $30 times the 2,143 would mean that we would have sales, and this would be the sales break-even point in sales, right? The 64,286 in dollars. And then instead of going to the cost of goods sold, which would be by category, we're going to go to the variable costs, which is by behavior. We'll calculate the variable costs as the variable cost per unit, $16. We're going to multiply that times our break-even point. Once again, that same 2,143 that we know that we need in order to break even, because that's what we're trying to prove here. That $16 times the 2,143 will give us a variable costs of 34,286. Then the sales, or revenue minus the variable costs, will give us a contribution margin of 30,000. Notice the terminology here. So we've got the total contribution margin. If you just hear contribution margin, you've got the total sales minus the total variable costs. If we have a contribution margin per unit, then we're taking the unit sales price minus the unit variable costs to get to that 14. In other words, if we have the contribution margin per unit here of that $14, and we were to multiply that times simply the number of units sold times the 2,143, we could get to that $30,000. There's rounding involved here, but we get to that 30,000 contribution margin. So you're going to have to start to break out the kind of contribution margin per unit and total contribution margin. You're going to have to start to break out the sales, total sales, and the sales per unit, of course, the total variable costs and the variable costs per unit. So once we have that, then we're going to just subtract out the fixed costs being the 30,000 in our example up top, the 30,000, and that's going to give us, of course, 0, because that's the point. We're at the break-even point, meaning we're at 0 if we plug this into our income statement. Now, there's going to be a tendency to think about this in terms of your normal kind of income statement. In other words, to start to think of costs that are up top because they're similar to what you would see in cost of goods sold type of area for a normal income statement here, to start to think of all the variable costs as those that are going to be related to cost of goods sold. And a lot of them are, because the inventory is something that's going to change with regards to increases and decreases in the sales. And the fixed costs, we start to think of them as basically the operating expenses, selling and admin. And a lot of them are, because the selling and admin tend to be more fixed. but that's not always the case. So you don't get stuck into thinking that's always the case, because you could have selling and admin up here if they vary with regards to the increase and decrease with sales. For example, the sales commission could be up here, and you could have some fixed costs down here related to things that are that you would apply to inventory, such as overhead. Oftentimes, could be down here on the fixed costs. Okay, so now let's just take a quick look at the breakout between fixed and variable costs. So what we're going to try to do is take a look at all our costs, and you could think of these as basically the income statement expense type of accounts, and break them out by category between fixed and variable. Now note, this is not a perfect world to do that. Again, we already saw that any cost, depending on the time frame you're looking at, can be categorized basically as fixed or variable in reality, meaning the rent, although we're going to say it's fixed, could kind of be variable if you take a step back far enough in time to know when the lease is going to be undone, and then you can change it if you wanted to, right? So it kind of varies at that point. And if you look at raw materials, again, once you buy the raw materials, they kind of are what they are in some cases. In that case too, if you zoom in other words, a lot, then at some point you can see them as fixed. So you have to look at some kind of relative time frame and say, okay, relative time frame here, these are the costs that are fixed in the time frame that I'm thinking about. These are the costs that are going to be varied. Also note, we could add a category called mixed costs, because the mixed cost might be something where they're going to change over time, meaning you might have a cost that has a fixed component and a variable component to it, and you would call that a mixed cost. We're not going to add the mixed costs here, because what we do with the mixed costs is we try to break them out still into fixed and variable using different techniques, so that we could still kind of break everything out into fixed and variable costs. So this is an assumption, fixed and variable costs, that has its benefits and has its problems. The benefits is the flexibility that allows our mind and our worksheets to do with regards to projections. The costs is that we're trying to put everything into these two categories that has, areas where it's not always perfectly fitting into those two categories, and it depends on the perspective of time with regards to those two categories as well. So the rent is something that we would typically think of as fixed, right? It's not going to change over time. The sales go up, sales go down. We still pay the same amount of the rent. So we would think about that as typically fixed. Wages per unit. Now, when you think of wages, those are things that we typically think of as different than salary, because you're going to be paid hourly. When you're paid on the hourly, that means that the employer, you would think, would have some flexibility to determine the number of hours that will be worked, and therefore those number of hours could vary with regards to the sales, especially if they're in the production process. Now, of course, in reality, that might not always be the case, because the sales, you might be required to have a certain number of hours that have to be worked, and so on and so forth. So the hours might not be as flexible as you would think in terms of the wages. But again, we have to kind of group them out as best we can. So typically when you're seeing wages, that's going to be something that's going to vary. When you see salaries, on the other hand, that's something that is fixed, like the admin salaries. The admin salaries are fixed. Now, of course, again, you can say, well, they kind of vary, because if you determine that there's too many admin people, you can just, fire people if the production goes up or down or something like that, or hire more. But again, in general, the idea, of course, is that in this time frame, the salaries are what they are on an annual basis, so they're going to be fixed. And then we have the raw materials per unit, and those, of course, would be variable, because they're going to change directly with regards to the increase and the decrease of the sales volume. We're going to be purchasing more and less materials, so that would be our concept of the fixed costs and the variable costs. So again, not perfect. It's not a perfect world to break these things out into fixed and variable costs, but you can see what the general kind of breakout would be. And then, we're going to use those as best as we can to make the best projections we can into the future.